Okay, welcome back to Self-Managed 360. Now we will look at how we can build a solid portfolio. Again, if we remember the previous videos, we've said that before we decide to invest on the stock markets, we need to make sure that the money we'll dedicate to our stock market investments portfolio will be money that we don't need short term. So if you're entering retirement, or if you have any projects that is coming soon, such as purchasing a house, you should try to invest this money into a more less volatile investment vehicles. But if you're young, if you're still active on the work market, if you are 25, 30, 35, 40 years old, and you want to invest a chunk of your investment funds into the stock markets to try to use the potential of growing your wealth even more than investing on government bonds, then you will have a certain amount of your money available to purchase stocks. So again, we've said that ideally what we will discuss here is you decide to build your own portfolio, and you will decide to manage it yourself. So you will open a online trading account, and then you'll start to make your own deals to purchase chunks of shares of companies. So our goal will be to obviously do better than the indexes. We want to do better than the Dow Jones Index or the S&P 500 Index because we want to put time and effort to pick our companies. We want to make sure that the time and effort we put into our managing our portfolio will provide us a better return than the indexes. So, the strategies that we'll be using, the backbone of our investing strategy will be to invest long term. So we want to be patient. We don't want to get stuck into emotions or hype. That's going to have the benefits of reducing our transaction fees. So as we've said in the previous video, when you are trading online with an online trading account, every time you're completing a transaction, a buy or a sell, you will pay a fee, a fixed fee on that is going to be maybe $10. So we want to reduce our transactions by purchasing stocks, shares of companies, and we want to own them long term to reduce our transaction fees. We also want to reduce our tax burden, so as long as we don't sell our shares, even if they grow in value, we will have a paper profit, but as long as we don't sell, we don't have an actual profit. So it's not taxable until you sell your shares. So if we own long term, that's going to help us to increase the overall performance of our portfolio by reducing our tax burden. We will then decide to invest on specific companies, and we will invest only in companies that are profitable. How can we know if a company is profitable? Because there's hundreds of companies trading that are not making a profit. We'll look at their income statements. So we'll come back to the income statement in the following videos, but we will look at the profitability of companies. We will put our money on companies that are profitable, that have a proven business model, and that's going to reduce our risk. If we invest in profitable companies, you should expect the company to be in business in 5-10 years, not go into bankruptcy. Obviously, that's not always the case, so we'll also stress to keep an eye on every stock we own, but investing in profitable business models will reduce our risk. We're also going to look for trends, increasing revenues, increasing profits. Companies that are increasing their revenues means that they're increasing their market shares, they're actually expanding their operations, which is a good news, and it's also going to influence how the stock price will do. Companies that are increasing their revenues normally will also increase their profits. It's not always the case, but it often goes hand in hand. So that's going to have a positive impact on the stock prices of the companies we own long term. We will also look at the financial health of the company, the balance sheets. So that's also available in the financial statements. You will find the balance sheet in the same document as the income statement. We'll look at companies that are increasing the shareholders' equity on a yearly basis, and also companies that are increasing their assets, the value of their assets, and that are controlling the value of their liabilities. And we will look at companies that have enough funds and cash equivalent to be able to pay for their short-term liabilities to avoid any type of potential financial troubles, short and medium term. We will try to invest in companies that are not operating in cyclical industries. So we will invest in companies that are operating in non-cyclical industries. Why? Well, because cyclical industries can be nice if we can time the market so that we invest when the prices are low and we can actually catch the upside of the industry. Cyclical industries can be natural resources such as mining, investing in mining companies when the price of metal is very low. Often the companies will not make a profit during a couple of years, and when the metals prices are going up, then the prices of the stocks should go up as well. So there's a potential profit opportunity in investing into cyclical industries, but it doesn't meet our investment strategy of investing long term. So we'll try to stay away from cyclical industries. We will look at key business fundamentals such as the return on equity, which we'll discuss later, currency ratio, which is obtained from the balance sheet, price earnings, profit margins. Price earnings will be the way we will try to evaluate fair market value for the shares we want to buy. So we'll also discuss valuation in the following videos. Then, obviously, like I said, we're going to consider value investment. We don't want to pay too much to own shares of a company because if we pay too much, even if the company is doing well, it may impact our overall long-term performance. So we want to try to buy stocks at a discount or with a fair market valuation. We will also consider the opinions of the market. So there's a bunch of people that are tracking stocks for us, financial analysts. So even though we want to conduct our own evaluation, it's wise to look at what professionals such as financial analysts have to say on the companies we want to own, because they are expert and they are providing some valuable inputs, and they can also, when they issue their reports, they can also have an impact on the price movement of the stocks, the companies we own or the companies we want to own. Finally, we will build a portfolio, a diversified portfolio. We don't want to invest all of our money into one company. Obviously, if we invest all of our money in one company, a very good one that is doing very good, the potential of increasing our wealth is high. But if something happens to this company, then obviously we'll be all in on only one company, and this is not what we want to do. So we'll try to own 15, 20, 25 stocks, depends on if we have a bunch of opportunities, we may want to diversify even more, but we don't want to own only 4 or 5 companies. and we don't want to own too much, because if we own too much, then there's a strong possibility that we will duplicate the performance of the indexes. So, as we said, if we want to invest some time and effort in evaluating companies, we want it to pay. We want to pay back, and we want to be better than only investing on funds that are tracking the indexes. So we're trying to diversify our portfolio, 15, 20, 20 stocks, but not more than that, because if not, then we should just purchase funds that are tracking the indexes. For the following video, we'll talk about profitability, income statement, and cash flow statement.